Welcome to STRAT this week for the week of January 23rd, 2023. Back in the studio, Will Woodall, joined as always by Mike Rarey. Hey, Mike.
Hey, Will.
We've got some cool new stuff here. New toy behind us we're going to showcase today. And we're going to start off by covering the returns in the market from last week. So we'll first look at equity returns and pull that up on the board.
Nice. It worked. So yeah, we'll look at asset class returns, focus on the furthest left column as well as the year to date. So just over one column there. And last week was a bit of a nothing week, not a lot going on, really consolidating the strong gains across asset classes that we've experienced year to date. So equities year to date, U.S. large cap stocks off to a pretty hot start, up over 3.5%, small caps up over 6%, and then foreign equities, developed and emerging markets, have really been leading the way, not only because of gains in local currency terms, but also the dollar continuing to weaken. Flip side of that is foreign currencies strengthening, which adds to those foreign equity returns that you see on the board.
Yeah, we saw a little uptick in volatility last week, characterized by some pretty big moves during the week on the equity side. What was the driver of that?
Yeah. Spending data. So we started to get more economic data last week, particularly around spending, and that was pretty disappointing. And aside from that, the Fed has really, so a number of Fed speakers, but they really haven't done anything to sort of lean into what the market is thinking the Fed will do, which is cut rates in the back half of this year.
Right.
They're really holding steady and saying, no, that's not going to happen. We're going to leave rates at an elevated rate for longer. So,
all right, so let's see how that impacted fixed income markets.
Fixed income, a very strong start to the year. So stocks are having a strong start to the year, but fixed income having one of their strongest starts to the year that we've seen in quite some time. So U.S. Treasury is up over 2%. Best performing has been long-term U.S. Treasuries. So the 30-year Treasury bond giving you a total return of over 5%. So a great start there. And then elsewhere in the fixed income markets, we're seeing credit sectors who are actually have a regime switch here. Yields for high yield bonds and emerging market bonds have been high, but now they're also falling. They flipped from rising to falling, and just barely so, but that is usually a price regime that we get excited about for fixed income. Mm-hmm. When it comes to credit sectors right now, given the macro outlook though, it's tough to get excited about price right now for credit sectors. So just a reminder, we're taking prices and the macro together all the time.
Right.
Positive news on a price basis might still mean bad news on the macro basis.
And so for viewers who might just be joining us or who might need a refresher, there's a lot of talk still from people we hear saying that rates are going higher, rates are going higher, rates are going higher. Explain what that really means in the light of some of these returns we've seen.
Yeah. It's probably easiest to differentiate between rates, short-term rates, particularly like the Fed funds rate, policy rates, things like that, rates versus yields. Rates are the things that policymakers can control. The Fed controls the Fed funds rate, which sets other short-term interest rates. Those are probably going to go higher as we get out to the end of this month when the Fed meets again, and then again in March. Yields are different. Yields are determined by the market. Yields are for securities that are not directly controlled by the Fed or a much longer duration. So that's why we talk about 10-year Treasury note yields. Mm-hmm. They can tell a much different story than the federal funds rate.
Right.
And they have been telling a much different story here year to date.
Which is why, said more simplistically, why you can still make money on longer bonds when rates are going up and the short end of the curve.
Absolutely. Absolutely.
Great. So let's turn to alts and look at the performance for last week.
Yep. In the alternative space, you saw global REITs rallying alongside global equity markets. So we would expect to see that. Plus, year to date, the other added bonus for global REITs is interest rates have come down. So REITs benefiting from equity market appreciation and yields coming down. In the commodity space, not a lot going on, some differentiation amongst sectors. What you see is the energy sector generally losing some ground year to date, primarily because natural gas prices continuing to come down, which is great news for a lot of parts of the world, particularly Europe. And then some positive news in the industrial metals complex, trying to price in a Chinese reopening. What does that ultimately mean for industrial metals demand?
So natural gas in particular, significantly down. Is that a supply thing? Is that a weather thing? What's the driver?
It's definitely both. So, if you look at Europe, Europe has been on the brink of an economic recession for quite some time because their lack of natural gas and rising natural gas prices were really going to shut down the economy. And now, just because the weather was much more mild than expected, the winter weather, that started prices coming down, and then at those lower prices, Europe was able to stockpile more and more natural gas, so there's just less demand, and it all works the exact opposite of way that it did last year.
Right.
Yeah.
All right, so let's turn our attention to the framework updates for the week, but liquidity in particular, and any changes we've seen there recently.
Not a significant change in the liquidity forecast, still low and low. We know technically if you were to look at our forecast, you would say low and rising, but this is not rising that you should get excited about. So just low and low. We know that when it comes to liquidity and monetary aggregates and the money supply, there is a lot of discussion about, well, what does the U.S. government reaching the debt ceiling, what implications does that actually have for financial markets and then liquidity more generally? So we can definitely speak to that as well. But overall, very difficult liquidity environment.
Right, and not really changing anytime soon. The blue line, that sort of the bottom line there, what does that represent in terms of sort of a hurdle?
Yeah. So. You mean
the gray line? Sorry.
Oh, the gray line. Yeah. So that's the primary regime definer. So that's high or low. So we want to be above the gray line. That's when the liquidity environment is very supportive, not only of real economic growth, but also of asset prices.
Right.
Anything below that gray line, there is a lack of liquidity, insufficient liquidity. That's why it's difficult for us to get excited about this little market rally we've had, because a rally with no liquidity is more of a short squeeze than something that's tangible that can actually build on itself.
Yeah, absolutely. So you mentioned the debt ceiling, the debt limit. Why does this even matter? Like, what's the point? Usually it's just politicians arguing over what the levels need to be set at.
Great question. So at the risk, we could go into this for many, many minutes that we're not going to today. If you want to hear us go on and on about the debt limit and why it matters, we actually have a video on that we shot the last time we reached the debt limit, which was fall of 2021. But what we want to speak to specifically today is what actual implications does this have on our outlook and on liquidity. And the biggest implication is probably net liquidity, which we can show here. So remember, net liquidity has been acting like a force of gravity. What is net liquidity? Well, you take money supply and you subtract out the other sub-monetary aggregates that really aren't liquidity, the Treasury General Account and reverse repo. And what you can see now, that's the green line, that's net liquidity. It has led the S&P 500, the blue line, basically since COVID. Liquidity has been in the driver's seat. And we've detached here a little recently. The S&P 500 around 4,000 price level. The liquidity fair value, so the fair value of the S&P as implied by net liquidity is still around 3,600, 3,500. And more importantly, this might actually get some news coverage, people talking about, well, what if the Treasury can't issue new debt? What does that do to net liquidity? Well, you would think in isolation that would mean net liquidity would go up, because what would happen is the Treasury would take this account that they have at the Fed, the Treasury General Account, and withdraw those dollars and spend them in the economy to fund the government without issuing new debt. That would suck up liquidity. But the other side of this is reverse repo. Reverse repo is probably going to go up and probably offset the drawdown in the Treasury General Account. Why is that? Because if the Treasury is not issuing new Treasury bills and you're a money market fund, well, you need to invest in Treasury bills. And if you can't, then what you do is you take your excess cash and you park it in the reverse repo facility. And so that's basically draining liquidity. So the Fed drawing down the Treasury general account, positive net liquidity, reverse repo going up, draining liquidity. These things should offset.
Right.
The green line should continue to go down as the Fed continues to decrease the size of their balance sheet. I
think that's the message here, is the green line should continue to go down. And secondly, that there's a substantial gap right now of almost 10%, 400 plus S&P points that could potentially evaporate in a heartbeat.
A gap that we have seen multiple times since this bear market has started, and a gap that has been closed over and over.
Mm-hmm. Yep. All right, so let's move on to inflation. Look at our updates.
So if we go to our inflation forecast, not a lot has changed here from the last time we spoke to inflation. Good news is the last few CPI and even the PPI prints coming in much cooler than expected. There are a couple things about that are just unequivocally good and bring our forecast down. The fact that inflation is losing momentum. Mm-hmm. Okay, so that should help bring down our forecast, which is great. The fact that it's coming in not only cooler, but cooler than expected. So that's key, a negative inflation surprise. That's bringing down our forecast. However, when inflation comes down faster than everybody expects, you have to wonder why. Is this just an immaculate disinflation? Is this just a soft landing? Is this time different? Inflation can just come down with no collateral damage to the economy? Or what we think is more likely, and what shows up in the rest of our framework, is inflation is coming down because demand in the economy is slowing dramatically. Mm-hmm. And if we want to get inflation down to a target that the Fed would be comfortable with, unfortunately, history suggests that there will always be collateral damage to the economy. And we're right now in that handoff point right now.
Yeah. And employment's still strong. Mm-hmm. So the Fed's ability to pivot based on this forecast doesn't look very likely.
Absolutely not. The Fed will not be able to pivot until there is weakness in the labor market. Wage growth is running at 5%.
Right.
That needs to get down below 3 in order for the Fed to feel confident that they can bring core CPI, core PCE running at 2 to 3%. How are you going to get wage growth down if the labor market remains tight? Well, you have to tighten harder.
And it's going to be tough back half of the year. Our forecast suggests that inflation is going to tick back up towards the back half of the year. So it'll be very difficult for the Fed to start to cut rates in the back half of the year. More likely to just keep rates at a high level and pause. Mm-hmm. So let's move on to economic growth. And we've already seen quite a bit of sort of anecdotal stories around the fringes on demand. Mm-hmm. We're starting to see some layoffs, especially in the tech sector, financials. Yeah. What does that look like for economic growth?
Well, what it looks like in the very near term, and we can show it out in a couple slides here, is the fact that the labor market is much stronger than expected, and we're getting a little rebound here from inventory and net exports, means we're going to have a pretty strong end to Q4 of 2022. We get that number next week. But all of that is being taken out of next year's expectations. So that's the difference between the dark blue line, which is going up, and the light blue line, which is going down. So we're going to finish 2022 on a high note. The layoffs clearly have not materialized in the data. The labor market keeps coming in hotter than expected, but we know the layoffs are coming, and that's causing a lower forecast for 2023. It's probably seen more clearly in the next chart.
Yeah, which is a new chart, which is a really good chart we want to highlight here.
Yeah. And so this is how we take the noise out. So what you have here, you break down GDP, real GDP growth into its components. So consumer spending, you get residential fixed investment, non-residential or business fixed investment, government spending, net exports, change in private inventories. And if you look at those 6 GDP subcomponents, the top 3 are the ones that matter.
Yep.
Why do we say that? Because the bottom 3, over the long term, add nothing to real GDP growth. They just add volatility. Mm-hmm. They're net nothings. And so you can see how these have all transpired throughout since GDP started to normalize in Q4 2020. And so we've drawn some lines here. That black line is the line that everybody's seen before. That's just real GDP. You can see how volatile that is.
Right.
The red line is the one we've added. This is trend GDP. This is the trend of the things that actually matter. So consumer spending, business fixed investment, and residential fixed investment. And if you look at that red line, you can clearly see the deceleration in economic activity. You can also see that going into Q2 of 2023, it's going to be really tough.
Yeah.
It's going to be really tough because any demand, any personal consumption expenditures that we're seeing currently are basically drawing down savings and increasing debt for consumers, credit card debt or otherwise. And so that's effectively taking future demand and bringing it into the present. This is a classic good news is bad news situation. Mm-hmm. If the economic growth right now is better than expected, that basically means we're stealing from 2023. And so 2023 will be worse than expected.
Yeah, if you just look trend-wise, these are some significant negative prints here.
Right.
So we're going to see a deceleration for most of this year.
Right. Yep. And that's why we still, when we talk about economic growth, we're still low and falling in our view. Mm-hmm. If you just look at the real GDP number we're going to get this week, you'd say, oh, low and rising. Have to filter out the noise. The trend is clearly low and falling.
So does this suggest recession, perhaps?
It certainly suggests that there is an elevated probability of recession. Net exports and government spending and inventories, they could definitely help skirt a recession next year if they all play out just right. But you just got to think about the narrative here. We've been running at an elevated recession probability. The trend in economic growth is slowing, and moreover, we're in the fastest liquidity slowdown ever. And the Fed probably isn't going to pivot. So the idea of just an immaculate disinflation, the fact that we're going to bring down inflation and soften the labor market without any collateral damage to the economy or a recession, given our starting point, it does not seem like the most likely scenario.
Seems highly unlikely.
Yeah. So,
and a recession in general terms is not a terrible thing. Maybe you just explain sort of why we think recessions are bad and what is a bad recession versus a not so much a bad recession.
We haven't had a run-of-the-mill business cycle recession in decades, which is probably why recessions get such an incredibly bad rap.
Yeah.
But this one, if it happens, you would argue that the Fed manufactured it on purpose to save the economy from the worst decade of economic, prosperity or lack thereof in history, something like the 1970s.
Yeah.
So, this is sort of a means to an end. If we want to bring inflation down, which is a tax on everyone, we might have to bring up the unemployment rate from 3.5% to 5%, which is awful, yes, but it's a tax on a few. Right. So if this ultimately defeats inflation, I think even if the Fed creates a recession, I think they'll be proud of their work, most likely.
Yeah, most likely.
Yeah.
What do we see in terms of data points or Fed speak in the next couple of weeks? We should be on the lookout for.
Well, we get the Q4 GDP number, and then the Fed goes into their quiet period. End of the month, we'll have the FOMC meeting. That'll be very important. And, more and more so, we're going to be watching the labor market. So as we get that January jobs report, that'll be important as well. So would not be at all surprised to see volatility pick up around the end of January into early February.
Yeah. Great. Well, that's it for this week's update. If you have any questions, reach out to us as always. Have a great week, and we'll see you back here next week.